and Stephanie to be here for the judges. And thanks, Peter. So we will have 5 teams presenting today. That Wolves of Smith, Amphin Powell, CSI for cybersecurity investment, Outstars, and Cash. Each team will have 10 minutes to present their company. It is a strict time count, so we will cut you at 10 minutes. After that, each team will have 5 minutes maximum for Q&A session. Then at the end of the competition, 3 of our judges will go into another room to discuss for around 10 minutes. So stay with us after the competition. We will announce the winner after that. So we will only announce the winning team. The other teams, we will give you a qualitative assessment of what you did good and what you did bad. Then the prizes and the other things will be delivered through email since it's a long meeting. I'll just start with the first team, Wolves of Smith. Are you ready? So we have Logan Fang, Mengyao Zhang, Nick Samir, Matsir, Sorosh. If you are ready, I'll hand it over to you. You can share your screens. Go ahead. Okay, Julia, if you are ready, you can start timing when they start speaking.
Yeah, sure.
Hello, everyone. We're Team Wolf of Smith, and we will be pitching Netflix for you today. I'm Suresh, and I'll start by going over the company profile. So Netflix is an over-the-top content platform and production company that provides its members with the ability to receive streaming content through a host of internet-connected devices. Netflix was founded in 1997 and really started by mailing shows in the form of DVDs, but it has since evolved into the leading streaming platform worldwide. Focusing on the management, Reed Hastings, the co-founder and co-CEO of Netflix, is a visionary leader who saw streaming coming and pushed for a subscription-based business model. Ted Sarandos, who is also the co-CEO, has also been instrumental to the success of the company and drove the revolution in Netflix's content strategy and has been responsible for all the content operations since the year 2000. Netflix breaks down its streaming revenue into 4 major geographic segments: United States and Canada, Europe, Middle East and Africa, Latin America, and Asia Pacific, and have over 208 million paid memberships and in over 190 countries. Finally, focusing on the shareholders, institutional investors hold the majority ownership in Netflix through the 81% of the outstanding shares that they control, with the top 4 institutional owners being the Vanguard Group, Capital Research and Management, T. Rowe Price Associates, as well as BlackRock Fund Advisors. Now, Logan will go over the industry overview.
Thank you, Sure. So I will go over industry overview. North America is a prime market for Netflix and its competitors. Major competitors are Prime Videos, YouTube, Disney Plus, Hulu, TV Plus, and HBO Max. With Netflix business strategy, it has secured top place in TV-based streaming provider in US. As a company service reach out to 75% household in North America. YouTube and Prime Video take its 2nd and 3rd places. With the phone user growth rapidly in the and technology evolving in the industry, so the short video streaming has grown at an extremely fast pace. So next, I will go through with the key risk points for Netflix. So Netflix is facing 3 kind of like a risk. First one is financial risk. Over the last 6 years, so the membership price go up to $15.99. It almost doubled compared with their competitors like YouTube, Amazon. They're still like a $5.99. Netflix still now be able to enter in some major markets in South Asia, like China. It kind of losing like $1 billion markets over there. European has the regulation that Netflix has to contain at least 20% of the local content in their catalogs, which increase their operation costs to buy out more local content. And also Canada recently announced a controversial bill against the streaming providers all the content have to be regulated and using recommend content, and it will pass on to a law in the future. And also after COVID, people starting to do in-personal social activities, and the cinemas are reopened. So it will take a part of the flows from online streaming providers into more in-person activities. So next, I'll pass on to my colleague Cassie to go over financial overviews.
Moving on to financial highlights, the company made about almost 25 billion last year in revenue, which is a 23% increase compared to the year before. And also the company's stock reached a historical high this January at $593. A 52-week low was happened last July due to a lower than expected subscriber number. Overall speaking, the company's stock price increased about 451% over the past 5 years. We do believe that this stock will keep the momentum and moving upward within the investment horizon for the following reasons. So first of all, the net profit margin is 3% higher than the industry ones. And also the company's EBITDA has been increased substantially over the past 5 consecutive years. Moreover, the company's cash flow jumped positive in the year of 2020. So with the improvement in profitability and cash flow, the company announced that it would not need to raise external financing for day-to-day operations, which is a significant move for the heavily in debt companies like Netflix itself. Having that being said, we're expecting the debt ratio and EV/EBITDA to reduce in the near future since the company has enough money to cover productions and business costs. Now, I'm going to pass it on to Mudasser.
Thank you, Casey. Our thesis is basically built on a 5-cornered star: content, pricing, cash, engagement, and subscribers. Firstly, during COVID-19, Netflix was the best friend to many. That has cemented its streaming dominance despite near-term subscriber volatility. It now has considerable pricing leverage in its model, as higher subscriptions have a disproportionately larger impact on profit against relatively fixed content costs. Secondly, the wolves believe in its content, the breadth and depth of it. It is a compelling value proposition, strengthening our long-term thesis. The narrative is shifting to margin expansion and consistent free cash flow generation, which Nick will talk about in a bit, and heavy focus on more originals. It's important not to confuse near-term noise and user gains with Netflix's longer-term thesis, which we believe is stronger than ever. A first-quarter subscriber base miss, which was 33% lower than forecast, was due to normalizing demand following a massive outlier performance in 2020, which we all know. We expect second half in 2021 much better as fundamentals remain strong and stock buybacks are expected. Moving on, we also see that given the addressable market size of over 700 million global broadband households, apart from mobile, we expect next season of growth to come from Asian markets. Currently, Netflix boasts 208 million subscribers with overseas and laser focus. As US and Canada matures, this means more revenue and growing profit. We expect Netflix approaching 300 million global paid subscription by 2025. Netflix's move into the $180 million gaming industry is a natural extension of its content strategy. We believe it's expected to be a positive NPV project. It's hard to measure right now, but it will help deepen engagement. We don't expect gaming to be a game changer at this stage. Well, at last, there's a reason Netflix and chill is a verb. That reason is high engagement. That has given Netflix pricing power. This should mute concerns over competition with its content performing well globally and driving strong subscriber growth. When it comes to cash, Netflix's debt profile is rapidly improving with strong top-line growth, expanding margins, sustained profit, and sustained positive free cash flow, and a huge $8.4 billion treasure chest. Its BB+ bond could be maturing soon, and the cash flow may jump to $2 billion in 2022, given strong EBITDA. Nick's going to take you through that and our valuation. Over to you, Nick.
Thank you, Mudassir. So there are three primary assumptions driving our valuation forward. So first, we think that Netflix is going to be able to continue to grow their membership base at about 17% per year over the next 5 years because of their expansion in Asia Pacific, where they're really just scratching the surface of that market potential, and their recent foray into the gaming market may convert a lot of casual users or increase a sticky user base to decrease the churn that they've been experiencing recently. Second, we think they're going to be able to continue to drive revenue forward at over 18% per year because they have market-leading original content that increases the willingness to pay to people that are loyal to the content over the streaming service. And next, we think that the inevitable expansion of their gaming platform will continue to be able to justify an increasing annual price. And finally, we think the company is going to be able to drive unlevered free cash flow forward at an accelerating rate above revenue because they become more disciplined in their expense management. And because they're more focused on their internal content portfolio, that spending is a lot more predictable and a lot more manageable now that they've already built such a good portfolio of content. So looking through how we analyze the valuation of the company, we looked at three angles. First, DCF is king, looking perpetual method as well as an exit EBITDA multiple, looking at EV to revenue and EV to EBITDA multiples. It's hard to construct a true peer group for Netflix because it's one of the rare pure play streaming content providers that operates on such a mass scale. So we really had to construct a composite between Roku, Disney, Facebook, Amazon, and Google to really get a better understanding of what this company should be priced at. All three of these valuation methods came up with favorable results. And looking at a 60-20-20 split between our three methods, we're looking at over 20% upside at $636.99 as a price target in 18 months. We think that they're going to be able to continue to drive average revenue per user despite slightly decreasing revenue growth rates. We think they're going to be able to maintain their current spending. And we think that 2.5 as a perpetual growth rate is very reasonable. So
sorry guys, time's up.
Yeah, I was just going to say, to tie everything together, we've got a buy rating, price starting at $636.99. Based on today's price, that's a 20% implied return, holding period of 18 months, resulting in an effective annual rate of 13%. Thanks for taking the time to listen to our pitch, and would welcome any questions.
Okay, anyone has any questions, please? You can raise your hand up or type in the chat box.
So you mentioned, this is Peter, that the company is fairly heavily levered and is using its free cash flow to pay down that or buy back stock. What is the amount of leverage and what is its interest rate risk in the event of, say, a 1% rise? What does that do to its cash flow and to its earnings?
Very specific. Yeah, I'm going to pull up. So leverage was more of an issue for Netflix, I would say 3 to 4 years ago, because they decided that they would switch to just being a streaming provider to an original content provider. So they heavily financed that with debt over the recent years, but their leverage is not very bad. Like their net debt to EBITDA is just over 1, which relative, I think they were at, even when they just turned EBITDA positive 3 years ago, that was around the 5 to 6 range. So their leverage is continuously improving. Like their average interest rate in terms of their debt, they get extremely cheap debt. I think it's the smartest way to go about financing. I do not think they should have gone to the equity markets a few years ago. I think they made the right move. And I really don't see much of an impact in terms of the interest expense, in terms of their impact on earnings. Can't give you a quantification.
I'd like to add to that by saying that they're BB+ rated. They're expecting a rating upgrade by Moody's and S&P. With a rising interest rate environment, we do expect the cost of debt to go up, and they're doing the right thing by reducing interest rate risk on the balance sheet by paying down that debt, despite that they're about to get a rating upgrade.
Just to follow up, what's the duration of their debt?
7 years.
Whole book?
That's the average.
Okay. Jeremy here. Yeah. So 2 things from me. Number 1, what do you think of the competition now that the legacy media players have woken up, excluding Amazon? So Disney has gotten itself together, and they're almost at Netflix's subscriber range. and then all the other smaller legacy media players have woken up, HBO Max merging with Discovery. How do you think that would impact Netflix's competitive position, especially within the US? Because US and Canada. Because US and Canada is important because US and Canada have the highest cash flow and profitability. And that's what's going to allow them to expand into emerging markets. So that's number one, just competition, and particularly in North America. And number two, what do you think about the co-CEOs? They keep on selling stock almost every other week. How do you think about management confidence in general? So just those two things from me.
Okay, I can didn't see anyone on mute. I can tackle that first question in terms of the overall competitive landscape. Of course, industry consolidation has been a recurring theme over the last couple of years as everyone's trying to. I see it as just a repackaging of cable TV. People are just buying all these services and just being like, hey, you like this show, you're gonna have to buy our all-in-one package. So I think that Netflix, I'm not sure if they really, maybe it was a prophetic prediction a few years ago when they decided to shift to original content streaming, but I think that their product portfolio is going to help increase the stickiness of the user base because it's Netflix original content that you can't get anywhere else. And I think that there's, like, a lot of people would think that there'll be price competition with people undercutting, but these companies that are consolidating are going to be boosting prices. We've already seen that with Apple. Their free trial is expiring and they're going to start charging people money. I don't think there'll be that much price competition. And I still think that I'm a loyal Netflix user for 10 plus years, so I'm obviously biased, but I watch a lot of original content on Netflix. So despite what's happening elsewhere, I stream that stuff, I pay for Netflix.
I'll take your second question and say that yes, there are leadership issues, but at the same time, it's become a behemoth in its own space, and it's a pure play behemoth. So whatever issues that we have at the leadership level, we don't perceive them as a key risk at this stage, where it's poised for super growth in emerging markets and especially Asia. Thank you.
This is Stephanie. I have a question related to gaming. Originally, I was going to ask about international expansion because US and Canada is their most profitable business. Given international expansion, lower ROI, why do you guys think it's a good strategy, first of all? And you guys don't have to answer that. Second, I was going to ask for gaming because Netflix, in my opinion, is more quantity over quality of their shows, and gaming is a very quality business because the high titles, most popular titles have a lot more people playing. Do you guys think it's going to be kind of a natural fit going in? Is it in Netflix DNA to incorporate the gaming segment well?
Hi, Stephanie, sorry. So if you don't mind, I will let the team to answer your questions in the chat box. We will move to the. So next team is team Amphin Pao. The pitching company is PayPal. Lee, Nikhil, Corey, Achint, and Natasha, if you are ready, go ahead. And if anyone have more questions for the last team, you can go ahead in the chat box.
Hi everyone, I'm Natasha Dawich, and today we are doing a stock pitch on PayPal Holdings. To start off, we recommend a buy on PayPal with a target price of $389.45 because it is undervalued by 32.18%, and its price could increase significantly in the next 3 to 5 years. Let's talk about the company itself. PayPal is one of the leading players in the digital payments industry that facilitates digital and mobile payments through a two-sided proprietary global technology platform, which links customers consisting of both merchants and consumers. It is a one-stop shop that offers a number of payment solutions, and with a market share of 54%, customers see value in using PayPal for being secured and convenient payment medium with a global presence. Since its spin-off from eBay, PayPal has been led by Daniel Schulman, and Daniel has built a strong credibility amongst investors, with company beating its expectations on 14 of the last 17 quarters. PayPal integrates several platforms to provide payment solutions, and to remain relevant in the payment space, it has engaged in multiple partnerships and acquisitions to fight off the competition. These engagements include partnerships with MasterCard, Visa, Uber, Instagram, as well as acquisition of Venmo, GoPay in China, and the last one being Honey that was acquired for $4 billion. Its main source of revenue comes from transaction fees, and about 54% of that is from the United States. We like this company because its growth comes from a strong network effect. As more customers join the network, the more incentive it is for merchants to sign up, thus attracting even more users, along with a solid balance sheet and cash flow numbers. And with a growth opportunity of $110 trillion, PayPal is diversifying itself by expanding into emerging markets and more recently entered into crypto space as well.
Yeah. Moving on to the thesis, with the Q1 results being out, on the left-hand side, you can see a bar graph of the last 10 quarters. PayPal have the strongest quarter this year with about 29% growth from its previous quarter, because of which they have already increased their 2021 outlook revenue growth by 20%. On top of that, the company expected to have a revenue target of by 2025 of about $53.4 billion, which is again around 20% CAGR. Additionally, they have been consistently adding new active users, growing at a rate of about 6% CAGR. And in the previous quarter of 2021, they have already added about 14 million new customers as well. They target to reach the new customers of around 750 million by 2025. Moving on, you can see on the TPV, there's been a rapid growth in the TPV from about $132 billion in Q1 in 2018, around 3 years back, to which is now $285 billion in Q1 2021, which is again a 29% improvement growth in CAGR over the last 3 years. On top of that, the preferences of using PayPal as a digital online payment wallet, it's one of its consumers representing about 38% of the respondents in a survey represented, saying that PayPal is the most frequent wallet, and they indicated that they would be more likely be using it, and hence it outperforms competitors as well.
Just to give you a perspective on PayPal's scale of operations, it is acceptable to use the word PayPal as a verb nowadays. Now going to the catalyst, Venmo is the growth engine. Venmo users are expected to grow 38% CAGR over the next 5 years. Venmo's total payment volume is expected to grow at the rate of 27% CAGR over the next 3-4 years. This transforms into 62% penetration rate for the P2P mobile payment market. The net cash position of PayPal is $10 billion. This helps him to grow organically as well as inorganically, like it acquired Honey for $4 billion. Square, its competitor, does not have the financial might to pull out such a huge acquisition. Also, PayPal has pricing power, and PayPal is planning to increase merchant processing fee from next month, and the merchants will continue to use PayPal services because it is better than its competitors. Going to Bitcoin, which is a very lucrative business for PayPal, in January, crypto fell by 20%. However, PayPal's platform generated a record volume of $241 million USD, and PayPal earned a spread and fee on these transactions. The digital wallet super app, which PayPal is going to launch, could be used to distribute government-backed digital currency. PayPal's buy now, pay later scheme, which is very popular, already reached $2 billion in total payment volume. And Affirm is a competitor of PayPal in this field. However, Affirm relies on strategic partnerships with Peloton for this. The advantage of PayPal is it already has its existing 29 million merchants. To conclude, PayPal is the digital bank of the future.
Financials of PayPal was compared with 5 public traded company in the industry. For the left chart, they are about the stock price growth since 2020 with EV over EBIT, showing strong growth after the pandemic, which is expected to continue in the future. On the right side, total revenue of PayPal is highest, although the revenue growth is slower than Square and eBay. EBITDA growth is still highest. Consider the size and the stage of the PayPal, which is preferred for investor to see, and showing an effective cost management in better EBITDA growth, which is supported by the strong cash flow from operating activities. For PayPal's valuation, we selected DCF and trading comparable multiplier approach because it never paid dividend and not going to plan to pay dividends in the future. Some assumptions. First of all, we assume the capital structure stays the same and stable. Second one, we assume historical cash flow growth rate will also apply in the next 5 years because fundamental factors expected to continue. Assume free cash flows grow at a constant rate at 21% for 5 years. This taken by geographic mean based on both free cash flow to firm and free cash flow to equity growth in the past 5 years. Then reduce to 4% going forward after 5 years. Also, we assume the interest rate and inflation is holding constant and no extraordinary event like COVID-19 happened, and our catalyst booster implicated successfully. By using free cash flow to equity, our target price is $384.67, which is 30.5% upside. By using free cash flow to firm, target price is $413.48, which is 40% upside. Also, we have done a sensitivity analysis for both to show the different price with different growth rate. Using equal weight for both to get the target price $399.08 per share.
For relative valuation, we compare several multiples and ratios within the peer group, and we can find that PayPal has preferred EV over sales compared to the average. And in terms of the profitabilities, even MasterCard and Visa have higher margin. When we look at the growth rate, PayPal have higher growth potential. In detail of the valuation, we use focus the revenue and focus the EV over sales to estimate the price. In conclusion, combining the estimation of two valuation methods, we give the target price of $389.45 with 32.18% upside potential compared to the current price. For the risk, we give 5 recommendations based on the overall risk. PayPal can face a few operation, compliance, and market risk. To highlight a few, there may be unsustainable low effective tax rates, cyber attack and technology risk, as well as changing customers' preference post COVID-19 in the future. With all risk discussed, management have anchored itself against business and operation risk. As for compliance and market risk, PayPal has worked on solidifying its security median and diversifying its business scope such that changing behavior will not harm. In terms of the quantitative risk, first, the average return and standard deviation indicates above average return with average volatility. Also higher than peers Sharpe ratio shows that PayPal managed risk and return more efficiently. The positive scaleness indicates that large gain may cover frequent but small losses, and relatively small contingencies indicates a lower risk compared to the peers. For the left chart, the up market performs more than offset the downside, and PayPal outperforms most of the peers in both sides. On the right, the max drawdown in line with peers shows an average downside risk. So overall, we think PayPal has relatively higher returns with average risks.
Thank you, everyone. We are now open to questions and answers.
Okay, go ahead. Sorry, go ahead, Jim.
Oh, sorry. I should have lowered my hand. Okay. For PayPal, what do you think about why did they break their exclusive agreement with eBay, and what is the impact on PayPal's prospects going forward because of that? And number 2, Venmo, I get, is the key driver, but Venmo is quote unquote less popular versus Square's Cash App. And in general, how do you think Venmo stacks up to Cash App? And financial services are arguably a commodity. So how do you think about the long-term profitability of these things? Yeah.
I'll handle the first question, which you are talking about eBay. So
Yeah.
I think PayPal's collaboration with eBay has resulted into restricted growth of PayPal. And now, since the exclusivity period is over, now PayPal is growing at a higher rate as compared to earlier. Now PayPal is entering into tie-ups with various parties, like PayPal is entering into China with a tie-up with Alibaba. So PayPal is free to grow at its own pace now, instead of being dependent on eBay. And it can tie up with almost anyone and everyone to grow at a higher pace as compared to the earlier growth rate, which was lower.
I do want to add to that although the merchants may not be able to use PayPal, the buyers are still allowed to use PayPal when they're making the payments as well. So even that portion is still available to the buyers of the items from eBay.
Did Jeremy, you get your questions answered?
They can answer it in the chat, but yeah, you should go ahead, Peter.
There's no mention of other competition in the traditional channel, which is Visa and MasterCard. And how do the merchant acquiring fees for PayPal stack up against those traditional cash flow engines?
So MasterCard and Visa are not fully comparable with PayPal because they are, I mean, there is an overlap in certain part of the business with PayPal. But PayPal has so many other things. It has cryptocurrency. It has other businesses like the discounting and all that. So frankly, these two businesses, according to us, they are not comparable on a strict basis.
Okay. Stephanie, you have some question?
Yeah, I have a question. What percentage of revenue is coming from Venmo right now? Do you guys have that data in hand? First of all. Second of all, I just want to make a comment. I think the biggest concern PayPal is it is competition, not only from Visa, MasterCard, and close competitors like Square. There are other new ways of cashless payment that are coming online. What the people call buy now and pay later models that are coming. Are extremely popular amongst Gen Z and millennials. And PayPal a few years back switched back to kind of funding neutral model, which means when you pay through PayPal, you can choose your funding sources either from a bank or from your credit card, not from a more favorable source or what quote unquote PayPal balances. I think it's a big testament to PayPal's competitive advantage kind of going down. So this is something that I would be watched for going forward.
Just a general comment. I'm still struggling a bit with the segments of revenue and costs. There was a lot of high level stuff, but I don't understand after this pitch the very basic revenue and cost generation points for this business. You've mentioned that it has a number of different discounting businesses and other things like that. It's not just a transaction company. So I think it would be useful, maybe you can let me know in the chat, how costs are segmented out versus revenues, and why you think all those different segments are going to simultaneously grow.
Okay, so Tim, I think Paul, you can answer Peter's question in the chat box. Next, we have our CSI team, cybersecurity investment, Thomas, Carol, Amir, Dylan, no Dylan, sorry, Cyprian. If you are ready, go ahead. The pitching company is McAfee Corporation.
Testing. Hello, everyone, and welcome to our stock pitch on McAfee. We are Group 4's cybersecurity investments. Our team is made up of Cyprian, myself, Amir, Carol, and Thomas. Next slide, please. So I'd like to just quickly discuss about the rapid growth of cybersecurity. We can see that this year, cloud is expected to grow by up to 23.1%. It's a growing market in terms of internet users, as well as there are 4 billion internet users and a CAGR of 8% and 6 billion internet devices. Currently, we're also in a state of work from home and transitioning to office hybrid model as businesses and consumers open up. And currently, a number of companies are committed to going mostly on a hybrid model approach and also working from home, such as IBM, Amazon, RBC. A little bit about McAfee at this stage and some of its competition. So before we go through that, just want to explain what size multiplier is. So that is essentially the presence of a particular brand on the internet and other social media. And so McAfee's current price is 25.66, and its size multiplier is almost 3,000. If we compare that with FireEye, which is also a developer of intelligence-led security and services platform, its current price is 19.76 and size multiplier of just under 800. CrowdStrike is a developer of cloud-based cybersecurity platforms, and its current price is as of $249.96. Its size multiplier of only 181 times. And Norton, which is a well-known cybersecurity and antivirus software provider with a current price of 26.01 and a size multiplier of only 67. Next slide, please. So our recommendation is a strong buy for McAfee with a 21% upside. It's based on this, its price target is of just over $31. And if we look at the last 12 months, the revenue is almost 3 billion, and with EBITDA is 0.5 billion, market cap of just over 11 billion, and enterprise value of just over 14 billion. And in terms of it's just high-level valuations, its EV over EBITDA is 28.1 times, and its forward PE multiple is 23.76. Now over to Thomas, who will talk you more about McAfee.
Thanks, Amir. So McAfee Corporation is a mid-cap security technology company specializing in consumer and enterprise digital protection services. It operates within the software and technology services industry, and it sells everything from antivirus, VPN, cloud, and other enterprise solutions. It is one of the most recognizable brands within that industry as well, having received multiple awards from industry experts like Gartner and PC Magazine. If we look at the ownership structure, almost 70% of the outstanding shares are owned by 3 companies. TPG Capital owning 40%, and the rest owning 16-11 by GIC Special Investments and Thoma Bravo. The management team is very highly talented. So the CEO, Peter Liev, formerly of BMC Software, another B2B vendor that specializes in cloud computing and workload, as Lynn Doherty, formerly Cisco Sales, and Steve Grobman, formerly Intel. Moving on to its financials, it operates within 2 distinct segments. The consumer segment taking up about 55% of the total revenue, and enterprise making up about the rest 45%. Looking at the last 3 years of revenue, you can see that consumer segment has been steadily increasing while the enterprise segment has been struggling to maintain its position after rebounding from a bad year. And looking down at the operating income, it's clear that the consumer segment is the profit driver for the company, and enterprise continues to post losses year over year. Continuing on, here are some highlights. So the total revenue growth year over year is 27.3%. That's higher than the industry CAGR. And the average PEG ratio, the PEG ratio, is less than 1 at 0.9, indicating that the stock might be undervalued. The average revenue per customer has increased for the past 3 years, and the active user count has increased dramatically for the past 4 years, ending up at 18 million active subscriptions by the end of 2020. And the contract value expired versus what they renewed has reached 100% for the third consecutive quarter in 1Q21. A little bit about the geographic split. United States dominates the market at 55%, the rest 45%. Moving on to Kyril.
Thank you, Thomas. Our investment recommendation is built up on 4 critical factors. The number 1 is expanding market and market share. So the consumer cybersecurity market offers attractive growth potential, with the current market size standing at about $13 billion, growing at about 8% rate. McAfee's business thrives on attracting and retaining quality customers. Thus, the company is operating in an expanding market with the potential of gaining market share. We expect McAfee will have 13% market share in 4 to 5 years' time. The second one is the track record and the management reputation. McAfee has 30 plus years of solid business track record, and it has the brand recognition, which can be leveraged further into the consumer segment. The third one would be the divestiture of low margin enterprise segment. McAfee plans to fully divest its low margin enterprise segment at a $4 billion valuation by the end of 2021. And they are in line with the plans as of now. Out of the sale profit, McAfee will pay out a special dividend of $2.5 billion, and they will also pay down $1 billion worth of long-term debt, and thus increasing the equity value of the company. McAfee has also partnered with Visa to increase the card security, which is a much needed thing at this point in time. The fourth, but the final one, would be the decent financials and incremental profitability for McAfee. In our projection, the above catalysts will make the company's net income positive, and McAfee is set to earn about 11% on an average on its return on capital. Moving on to the next slide. So we used 3 valuation methods: free cash flow firm, EV over EBITDA, and EV over revenue. And here is our valuation summary, including the range, taking into account the sensitivity to the valuation inputs of different valuation methods. Taking the 3 valuation models, weighted average based on our confidence in them, our final rating gives us a fair value estimate of $31.02, and that offers us a 21% upside. So our key assumptions here include a revenue CAGR of 11%, and the major drivers of that would be moderately diluting average revenue per customer over the years, but there will be a significant increase in sub base, leveraging out of its brand recognition. We expect the sub base to grow to 30 million by the year 2023, which is currently about 18 million. And we also assumed stable OpEx as a percentage of revenue going forward. Now I'll hand it over to Cyprian to talk about the risk factors.
You're muted, Patty.
Thank you, Carol. McAfee investment is not without risk. We see that the business risks, selling the enterprise segment has been received with some few hitches. Investors are not too happy, so that has affected their market price. We also feel that the huge competition within this industry will create a lot of pressure on the share price going forward. We are also seeing that first-time subscribers are giving huge discount, about 20%, to come on board. This is a niche kind of selling, which has technically have an impact on McAfee, diluting average revenue per customer. We also see that since Windows Defender is offering free antivirus for its users, we see this might have significant impact for the first couple of months on McAfee. We also see that in the market risk segment, according to Buffer Indicator, it shows that the market generally is value, and that might have significant impact on McAfee shares, given that we expect the entire market to come again.
Sorry, Tim, time's up. So I'll open
Okay, thank
to
you.
the question channel.
Jeff, why don't you start?
Peter, go ahead.
No, you can start, Steph.
Okay. I was just curious why you guys, obviously cybersecurity is a growing industry, that's for sure. And why do you guys, I was just curious, why do you guys pick McAfee versus other competitors? Obviously, you know, with the selling of their enterprise businesses, they're going to be more focused on consumers. Why do you guys think focusing on more on the consumer is a better way to play this trend versus the enterprise competitors?
Hey, thank you, Stephanie. That's a great question. So going back to the first slide, I think we focused on McAfee as a company mainly because its market cap versus its revenue is just so much higher than the other companies. For example, CrowdStrike with a market cap of 56 billion barely makes a $1 billion revenue per year, whereas McAfee has about a fifth of its market cap and sells 3 times its revenue. And for the other companies, it's all the same. And we feel that with us selling off that enterprise part of the investment of the company, that we can focus, as you said, and gain market share in where we dominate for the past 30 years.
Okay, thanks.
What's the special sauce for McAfee versus its competitors that would make it attractive to someone like me, who's a retail acquirer of computers?
I can tell you right now that if you're comparing using Windows to McAfee, the McAfee interface is just so much cleaner. It allows you to transit between different services. It's an all-in-one platform. You have everything from VPN, from your mobile phone being protected, your internet, child lock, or other services, all in one platform. Windows, you have to navigate through multiple windows, going to set multiple settings, and then sometimes it's very finicky. There's been a lot of traffic on the internet complaining about other antivirus softwares. Now, McAfee sometimes included, but it's ended up on the top 3 list of a few of the vendors or a few of the reviewers on the internet. So it is a very reputable company with a great interface. And I feel like interface is probably the most important right now, given the number of new users that are entering the internet space.
Is this going to make Apple computers more attractive because they need all of that?
Apple has always had the reputation of being virus-free. I'm not even sure any Apple users would be looking at antiviruses, but if they were, and they were a Visa card holder, I would contact Visa to get that special discount. This is probably the cheapest option you're going to get.
Okay, thank you.
Yeah, sure. And you can just answer this on the chat. What is up with their enterprise segment? Because when I look at their financials breakdown, revenue is split between consumer and enterprise, but on an operating income level, it's 200% consumer. Enterprise doesn't make any money. So maybe just help me understand what are their plans for enterprise, and in conjunction, does the involvement of TPG, Thoma Bravo, like these are private equity shops, like are they planning to have a special situations like a carve out? Yeah, so maybe just those 2 things. You can answer in the chat or you can rush it right now, but
yeah,
good
perfect.
job.
Well, thank you. So the enterprise piece was acquired from Intel. So Intel actually owned McAfee's enterprise market until recently. They divested, and the income is due to a lot of restructuring charges. They had to pay retention to its key staff to keep that enterprise engine running. That's why it's not that profitable compared to the consumer segment. And that being said, they're going to spin off that enterprise segment to another, I think it's Symphony Technology Group, another private equity firm, by the end of the year for $4 billion, going to pay off some debt, going to release a one-time special dividend. So we think that's going to refocus that company. Hope that answers your question.
No, I might actually look at this for my own fun. It's interesting. I like special situations like this. Okay, cool. I have some follow-ups on the chat, but thanks, guys.
Thank you.
Thank you. Next team is Outstars, the pitching company CI International Inc. Go ahead, Oscar, Rajib, Etsy, Amir, and Kian.
We don't have any sound.
Sorry, Rajib, you are on mute.
Well, sorry guys. Hello, we are Team All Stars. And we'll be presenting CACI International today. Our final recommendation is buy with a target price of 316 per share with an upside potential of 20%. And we'll now discuss about the underlying reasons why we believe the stock is buy. I will hand over to Oscar to proceed from here.
Thank you, Rajib. CACI International Incorporation is a leading provider of expertise and technology to enterprise and mission customers. The firm conducts its operations through a variety of subsidiaries in the United States and Europe. There are 4 main customer groups within CACI. From the revenue perspective, we can derive revenue mix in 3 ways: customer type, products, and types of contracts. With the most revenue comes from the mission, which with 60% of revenue and has mid to high margins. For products, with both expertise and technology, both of them have a 50% of each. Next slide, please. And the current stock price is at $264.70 per share. Compare the return and volatility with the benchmarks, we can see that CACI has a very good return and outperformed the market. With all positive increase in the key metrics, from the past 20 years, CACI has more than CAGR of 13% increase in revenue, net income, diluted EPS, and operating cash flow. Next, please. And so how does CACI make money? There's 3 main steps. First is to win a new business, and next to try generate margin expansion and cash flow, and the last, deploy the capital for growth, which provide new capabilities and customers upon which to grow. Also, they focused on their corporate social responsibilities with ESG approach. And next, I will welcome Etsy to talk about the industry analysis. Thank you.
Thank you, Oscar. Total addressable market for the cybersecurity industry is currently $230 billion USD. Worldwide, the cybersecurity industry is forecasted to grow to $345.4 billion USD in 2026. This is a CAGR of 10.9% from 2021 to 2028. In terms of the sectors that account for the cybersecurity industry, government and defense do account for the highest revenue share, with it being 24% in 2020. In terms of some of the industry opportunities, there has been and will be increasing adoption of Internet of Things, as well as increasing investment in smart cities. This will require use of various technologies and networks as they become more commonplace. Additionally, COVID-19 and changing towards remote work, as well as improving performance in emerging markets or other opportunities. Some of the risks that the industry face are very high cost implementing this cutting edge IT services, as well as increased more sophisticated forms of cyber threats, and as well as different regulations in different jurisdictions and countries that companies have to comply to. Some of CACI's top competitors include Momentum Service, PAE, Sonalist, Perspecta, and I've also shown some of the revenue that these companies have. Next, I'll pass it on to Rajib, who will discuss investment summary.
Thanks, Etsy. I will go through the underlying reasons why I believe that the stock has an upside potential through the growth stories. The first one is the company has a large pipeline of high value contracts at a regular interval. The company is or has been operating for last 58 years and having a very trusted relationship with the Department of Defense, backed by their excellent service quality. if you see the quarterly contract award of last 3 years, you will see that 2020 quarterly numbers or contract awards are a little bit at the lower side. That is just because of COVID situation, because even the federal government had to reallocate their federal spending to other private sectors. But recently, the government also has declared their federal spending for the next 5 years, and we see that the budget spending will be increasing by 1.4% in the next year to 715 billion. So from that, we believe that CACI will be getting a lot of contracts going forward. And the company also have a very balanced strategy to grow organically and inorganically. In an organic strategy, they always focus on strengthening their current customer base along with penetrating to new customer segments, and which have been also supported by their revenue numbers during last 5 or 6 years, which has been with a CAGR of 15 to 16%. In inorganic growth, they always focused on the merger and acquisition, which is the key priority. They have already executed 26 merger and acquisition deals, and the recent deal was with Ascent Vision Technologies to differentiate their products, and they have been getting a lot of benefits through this deal. And they have very strong financials. To have a summary, the margins have been very, very healthy, and we expect that EBIT margin will improve by 210 basis points by 2025. EPS will resultantly increase by 13% CAGR. The company also have a very comfortable level of leverage below 40%. So we believe that company has a room to grow whenever they need to issue debt for the capital spending. The company has been generating robust cash flow for the last few years, and we expect that the company will grow 6.3% CAGR in FCF. We'll discuss now investment risks. Kian will do that. Thanks.
Thank you, Rajiv. I'm just going to give you a quick overview of some of the risks we've identified for CACI International. One of the biggest ones are that the company itself derives a lot of its revenue from federal government contracts. It's about 95% of their total revenue in 2020 came from federal government. And that just makes them a little bit sensitive to budgetary policies, some unfavorable provisions that are very typical in these types of contracts. Furthermore, within the competitive landscape, this industry, generally, the contracts are awarded through a competitive bidding process. So it just forces CACI to maintain that competitive advantage and keep working hard on building those relationships with these government agencies. And then just a few of the strategies that CACI has pursued to ensure that they stay competitive is, of course, within the government contracting space. They've actually received the WASH 100 award, which is a very prestigious award in government contracting for the past 2 years consecutively. Furthermore, within the space, they've also been leading a lot of innovation using artificial intelligence and deep learning techniques, as well as receiving a new Best Product Award in 2021 for a multi-sensor imaging system. So these are a few of the different strategies they've been taking, and just to build their brand equity and strengthen their position in the market. And I'm going to pass it on to Amir, who's going to go over some of the financials and valuation metrics.
Great, thank you. Talking about the financials, we started with historical and projected revenues and searching for growth drivers. The company has strong bonds with both parties in the United States. However, historically, they tend to grow slower under democratic governments. That's why we used more conservative growth rates for the forecasted period, resulting in 5.6 CAGR for revenues. Moreover, leveraging their technological abilities, they are signing more and more technology-based defense contracts from DoD and federal enterprises. Next slide, please. The economic spread shows that they are performing better than most of their peers in wealth generation, and always indicating that they're indicating better performance than the peers. Also, the management has started reforms in operations. Moreover, using the latest technology improved their costs, and we assume this improvement would continue in the coming years. Next slide, please. Going to valuation, our DCF model suggests the target value is equal to $328 with an upside of 24%. Next slide, please. For market-based valuation, most analysts used PS, PE, and EV to EBITDA for this company, and we can see the summary of valuation that suggests our DCF valuation is consistent with P and PS. And next slide, please. And at last, we ran a Monte Carlo simulation to validate our recommendation with probabilities. So this is the final distribution of prices, which suggests more than 61% of outcomes yield a share price more than 10% above the current price, which supports our buy recommendation, and 39% of outcomes yield a share price more than our bull scenario. Thank you very much.
And to reach the final valuation, we taken a weighted average approach. So our recommendation is buy within 20% upside potential. Thank you, everyone. We are open for question and answer session.
That was very good. Good valuation slides and pretty strong cash flow. Has the company been building over successive political parties, primarily in the US, it looks like, through different regimes, like a successive Democrat and Republican, etc.? Do they attract all buyers, as it were?
I believe that the company has been successfully, maintaining the relationship with the Department of Defense, irrespective of, which government is in power. So, so I believe that this strategy will continue to and give the company better awards in contracts.
With the growing cyber risk that the whole world is facing, and blackmailing, etc., do they have performance covenants and any downside risk in their revenues should they their systems that they have consulted on and implemented be attacked and defeated?
From the revenue perspective, yeah, there is a downside risk, which I think in investment risks we have already analyzed, which is almost 96% of the revenue comes from the contracts from Department of Defense at US. So which is a little bit, very skewed to one party, kind of. So yeah, but they have been, doing that for a long, long time, just because of that strong relationship and bonding and trust. So not in mid-term or near-term, we don't see any kind of risks in that area.
Jeremy?
Yeah, I think one big question for me, it looks like a pretty good, steady business. They have a differentiated franchise. But the thing for me, my only question would be, when you forecast the margins, it looks like it's a pretty straight line up. But if you look historically, it's a bit lumpy, a few bips jumping around every other year. What gives you the confidence that they could execute on that straight line up of margins? Yeah, if you click to slide 15. Slide 15, I think. No, not that. 15.
I will
yeah,
take
that one.
Yeah.
Yeah.
We can see that just the net income is fluctuating, but for the past 5 years, we can see that the company has kept their margins constant, and we assume this will continue for the next years. And if we analyze 15 years of the data they had, and except for the Trump administration, they had really smooth revenues and margins. So I think this will continue to, yeah.
Stephanie?
Okay.
I have 2 questions. First, what trend does this company reflect? Can you explain a little bit more about that? And second of all, just a small question is there a difference, the contract bidding process, as 95% of the contract is coming from the government, is the process pretty much the same, versus the industry? I'm just not too familiar with the government contract bidding process, and what is the determined factor for them to win? Historically, have they been pretty successful? Like 8 out of 10 times they're winning the contract. Just a little bit color on that.
On the contract, I mean, bidding process, the bidding process has been or should have been fair throughout the past years since it's in a developed markets bidding system. And the company has been consistently winning biddings from Department of Defense. I think it's mostly depends on the service quality and the technology they provide. They also heavily invest in their technological advancement internally to cope up with the increasing or changing demand from the customers. So I hope that answers your second part. What was the first part? I'm sorry, I didn't get that.
What trend does this company what's the underlying macroeconomic trend that's going to favor the company?
Yeah, I mean, every country is, or even US is, always investing heavily on their national security, especially the Department of Homeland Security and Department of Defense. So, and these investments will continue to grow because most of the revenue is coming from that segment. So we think that will not change, in the downside too much in the near future. And other than that, the company is getting changing their strategy to attract more enterprise customers. So they have been operating their venture also in Europe. That's in a very limited scale, but we believe that going forward, revenue from that portion will also improve, but gradually, not in a very significant way.
Can I add some? Sorry, go on, Peter.
Amir, sorry. You can.
Under significant restrictions in their contracts with the Department of Defense to do business with anybody else, and certainly to share their knowledge, which is their competitive edge. So it's really just the growth of the US defense budget that's going to drive their growth.
That is one of the major catalysts for this company.
Okay, it's also a limitation.
Yep. In other way around, it's a limitation because there is obviously a confidentiality agreement about sharing the intelligence with others. And I think that is fair enough. That's why probably they're getting good margins over the business. So that justifies the confidentiality agreement in this case.
And last question, because I don't know if maybe you can put it in if we don't have time. Pipeline. What's their pipeline look like?
Yeah, right now the total backlog is.
Sorry,
yes.
You can answer the question in the chat. I'll go to the next.
I will take just one sentence. The total, till date, the total backlog is 22 billion, which means this 22 billion will be, offering good opportunity in the revenue side for next 2 to 3 years, because most of the contracts are for long term, 5 to 10 years.
Okay.
For the bidding.
Okay, thanks.
Good. Okay, we can go to the next team. So next team is Activation. Team Cash. The company is Activation Blizzard. So Ashraf, Hyun, Carol, Adil, Cynthia, Steven, you can go ahead.
Cynthia, could you share your screen?
Yep, for sure. Sorry, my computer is lagging a little bit. Just give me 1 second. Let me know if you guys can see this.
Yep.
Yep. Okay, perfect.
Yes.
All right.
Okay, so let's get us started. So hi, everyone. My name is Ashraf.
We're Team Cash, and we're here today to present a strong buy case for Activision Blizzard, ticker ACTVI. So let's start with some company background. Call of Duty, World of Warcraft, and Candy Crush. What do these games have in common? Well, they're all owned by Activision Blizzard. The company develops and publishes entertainment content for video game consoles, PC, and mobile. What we wanted to highlight for you as potential investors is first the diversified business model of the company. So the company generates revenue from product sales, but it also generates profits from in-game subscription and other revenues as well. In addition to that, over the last 4 years, the company has an average growth rate of 5.2%. So we believe that these two indicators are strong evidence of the company's strength. And now if you move on to the next slide, just to examine the company industry, well, the video gaming industry is mostly dominated by 4 major companies. We have Electronic Arts, Microsoft Corporation, and 2K. And the industry is quite competitive. The barriers on entry are quite high, competition is high. But with that being said, Activision Blizzard has the biggest market share with 14%. Now, in terms of key trends moving in the future and what would generate growth, mobile gaming is booming, and it's expected to generate the most growth for all video game companies. And Activision Blizzard is set to take advantage of this growth. They already released Call of Duty Mobile, which generated about $1 billion worth of revenue. They also own Candy Crush, and they're expected to release Diablo as well. Now, with that being said, let's move on and look into the financials.
Thanks, Ashraf. So taking a brief look at their stock price over the last year, we can see that the Activision Blizzard stock has seen some pretty strong growth through the year, increasing from about $79 on July 17th, 2020 to about $92 just this July 16th. And so a lot of their growth has been driven by strong earnings in both revenue and EBITDA, especially as you can see in Q4 and Q1, they outperformed their budget by quite a bit in revenue, which really was able to drive up both volume and stock price. In addition, share buyback announcements and also executive changes have affected the stock price positively, particularly an announcement to the CFO change to a company veteran in Q2 of 2021 was really able to drive up the share price, as you can see in the chart. So item that did drive down the stock price this year was this actual annual general meeting in the most recent quarter, which was adjourned because of shareholder displeasure on the company's advisory executive compensation, because the CEO was receiving more than he should have in stock and option rewards, and that actually caused the stock price to fall by 3%. So taking a look at some of their key line items, we can see that Activision has experienced strong top line and EBITDA growth over the past 5 years, and they also have a very low low debt to EBITDA ratio. And as you can see, they've been gradually delevering at a negative 5.5 CAGR. In addition, you can see that they generate strong free cash flow, and it's also a very high percentage of their revenue, which indicates that the company is cash flow generative and has a lot of cash to deploy into to invest back into the company and pay it out to shareholders as dividends. Moreover, just looking at a key item of their cost structure, which is R&D, their R&D spend has been increasing throughout the years, and it's one of their most significant expenses, considering the fact that they are a video game business and they invest heavily in spending on their intellectual property.
So looking at Activision's historical value creation for shareholders and continued focus on maximizing the returns, we believe that Activision Blizzard will provide QUAAF a strong return over the next 5 years. So from evaluating Activision's share price performance in the past 5 years, it has returned over 120%, which is one of the highest within the industry, compared to EA, for example, which has only returned 87%. And in part of the stock performance, Activision does a biennial share buyback, causing the stock price to drive up, as Cynthia stated earlier. And in combination with this buyback strategy, they also provide dividends, and they're one of the only companies within this space that does provide a dividend due to the size of its market cap, taking up 28% of the total market cap in this space. And these dividends have also increased in pay over the past years. Even when revenue has dipped in 2019, they wanted to ensure that shareholders still got their value out of it. And looking into their ROE, they averaged around 14% in the past 5 years, and it's steadily increased since 2012. And compared to other companies, its ROE is relatively stable. However, we do project that ROE for the next 5 years will increase as Activision Blizzard has more of a methodical and slow merger and acquisition strategy. For example, their acquisition of King franchise has provided them a strong dominance in the mobile space. And we think that they could potentially expand into VR and AR later on through strategically analyzing which company to look at. And the different segments will be explored next.
Our second investment thesis focuses on improvement of strong brand and established franchises. The company operates across 3 major business segments as seen on the slide. So with Activision, for Call of Duty, the introduction of the free-to-play and mobile gaming has more than tripled monthly active users to a record high of 150 million users. The integration of COD across mobile and PC gaming consoles shows strong conversion of players towards premium gaming, and in-game revenue growth has been about 60% year over year. And with the VR gaming taking off and headsets becoming more affordable, we see potential for growth of the COD franchise into the sphere. With Blizzard, the very well-known World of Warcraft franchise maintains strong momentum and has strong new product offerings, which are extending Warcraft and Diablo as well into mobile. The alpha testing for some of these new product offerings are showing high testing viewership, some of the highest that Blizzard has seen in history. With 24 million monthly active users, Blizzard has adopted a new strategy of alternating between releasing all new and classic expansions, which could cause WoW's revenues to spike annually instead of the typical biennial in the near future. And we see tremendous opportunity for Blizzard to expand the WoW franchise into console by bringing the core game to PlayStation 5 and Xbox. With King, the makers of Candy Crush, they continue to benefit from strong growth in the smartphone market, which is forecasted to grow to a net about 4 billion users globally. With about 258 million monthly active users, they've taken strong initiatives to broaden the payer base and deliver more frequent content and features to their portfolio titles, which drives a lot of in-game revenue. And so with the King acquisition, it's driven a lot of synergies, which has accelerated the COD, World of Warcraft, and Diablo shift into the mobile platform, and the company. And acquisition of this company is leading to a lot of openings within developing countries, which is expected to be a key revenue driver and a key driver for demand in the future. With all these 3 business segments, demand seems to be very strong and customer engagement seems to be very high. And with major expansion plans into Poland, China, Australia, and Canada, Activision Blizzard has already tripled the size of certain franchise teams since 2029 and is planning to hire an additional 2,000 developers in the coming year. Valuations.
I guess for the valuation, starting from the operating model, we do expect the revenue growth will be strong in the next few years. Just because, first of all, we expect some of the COVID momentum will continue. And also, just like my teammate just mentioned, they had a great track record expanding their business in different segments, in different market as well. And also they have a bunch of high quality new franchise waiting to be released, which will attract more customer. And lastly, they're expanding the team, which will be big player for the revenue growth. And also lead to my second point that the cost of revenue will grow as they're hiring more employee, more developer, which may lead to lower EBITDA margin but we expect that it will bounce back. Just historically, they have been managing their operating expenses very well. And so moving to next slides, we have a WACC calculation. So I just take 30 years historical average based on the operating history that the firm has.
Sorry, team, thumbs up.
Okay.
Sorry, Juan. So we'll go with questions.
I guess I'll start. So the company currently has 8.6 billion cash with 3.6 billion debt. I think if you can go back to the financial slide, end of 2020, and it's generating about 2.2 billion free cash flow. The last acquisition, I think, is King's, and they made the total. I believe they paid about $5 or $6 billion for that. Mostly that's the Candy Crush title company. What do you guys think the company is going to do with the cash? Do you see more acquisitions in the line, or just a little bit color on that?
I can take a stab at this. So I think historically, like the biggest acquisition they've probably made is in King, which obviously paid off very well for them. I think since then they haven't made a ton of other acquisitions in terms of companies, but what has been happening is that their dividends have been growing year over year, and they've been kind of paying that back a lot to shareholders. So I think it's pretty likely that they'll continue to do that in the future.
Also, just to add on to that, so there does seem to be a significant push towards hiring a lot of new developers and trying to push towards these new product launches. So with that, it feels more like if they're not going more of that acquisition route and trying to push for more of the newer product development and moving into mobile more aggressively.
That new new developers that they're hiring is going to boost their costs and reduce their margins. I saw the 1 year that they had their reducing margins, they actually lost a lot of share value. So what do you think this is going to do to their margins with the new developers? Anybody?
Well, we don't necessarily think the low margin that's really an issue for the company, because if we look at the past 5 years, the EBITDA margins, it fluctuates around 3% over time. I think overall they've been doing a very good job managing those expenses, and hiring more people definitely will just add more expenses, will reduce margin, but in another word, it will be the upside potential because they may develop more great franchise. Yeah.
Jeremy, do you have something quick?
Yeah, sure. Yeah, I follow this company heavily because of work. I guess my biggest question is so they're gonna start shifting more of their IP into mobile. What is the how do you view the profitability of mobile products versus console and PC products? You don't have to have a hard number on that, but like just give me a sense of how do you think about the difference in profitability in selling through the phone versus selling through your PC or console.
I think that profitability would be relatively higher with the mobile, because with consoles and PCs, there's a large upfront cost, and they're not necessarily something that you would have, like not something everybody would buy. Whereas with a phone, everybody basically has a phone, and downloading a game.
Monetization is lower. Monetization is lower for phone, though.
I think that maybe they're going to try to play the volume game there, versus with yeah, with PlayStation and Xbox, like you'll have a higher margin on monetization, but relatively fewer purchasers or buyers or sales.
I don't
Yeah.
know if this helps.
Oh, sorry.
I don't know if this helps, but I know that for Diablo, they have I think it's Diablo Immortal that they're introducing onto mobile, and it's supposed to be an in-between between their console games. I think like if they do connect their console games to mobile, like just the storyline, they'll kind of retain loyal fans, and they'll move back between both console and mobile. So that could be another driver.
And sorry, just to add to that, they've already done that with Warzone and Call of Duty.
Thumbs up. Everyone, just stay with us for 10 more minutes. Peter, Stephanie, and Jeremy, I just sent out a private link to you. You can discuss in that room. So everyone can take a rest, wait for us to come back and announce the winners.
Thanks, everyone. Good job.
Thanks, everyone. Thanks for your presentation. Everyone did great.
Thank you very much, everyone, for patiently waiting. So we just had a nice little judges deliberation, and just give us a few seconds here. We can make sure we get Jeremy, Stephanie, and Peter back in the room. Sorry, everyone can hear me, right? Okay, I got thumbs up, good. Okay, so I'm just making sure there. I see Stephanie's back, Jeremy's back, and I'm just waiting to see if Peter is back as well. Looks like Peter just joined. 1 second here. Okay, so first of all, thank you very much from everyone at QUAAF. Thank you to the operations team for organizing the competition, and thank you in particular to Stephanie, Jeremy, and Peter for giving their time today to the judges for the competition, asked some fantastic questions, and especially also for Stephanie and Jeremy for giving up their time on the back end of this as well. That's certainly a coveted prize for the competing teams. With that, we will hand it off to, I believe, Jeremy first. I believe we're just going to have a few points. Actually, sorry, we're going to go to Peter first for his overall comments, and then we're going to have some specific feedback from Stephanie and Jeremy, and then finally we will announce the winner. What's quite exciting is that we've had a gift given to QUAAF to the amount of $5,000, and that has been earmarked to invest in the winners of the competition today. And that is, of course, with that little caveat of that we will be doing the regular QUAAF due diligence before the investment is presented to the board. But certainly we have that little piece of cash to go for the winner of this competition. So that's quite exciting. So with that, I'll hand it to Peter just to make a few comments.
Well, first of all, I want to say I'm always impressed with the high caliber students at Smith Business School and the graduate programs. So thank you all for participating. I know that's a lot of extra work, and but I think it was very good for me. I'm an active investor, so the way I and your fellow judges were evaluating this were on the criteria that you saw earlier, but also, would we as individuals want to invest in this based on the presentations provided? And I think there were compelling arguments in all of the presentations, and it's tough to do it in a 10-minute elevator ride. What I was looking for is, and again, it's partly because I'm an old guy, is certainty in cash flows and strength of balance sheet. And there were some groups that were better than others in presenting that element, which is particular to me. I'm not a guy who invests in aspirational stuff. I like tangible stuff. So that's my bias in this whole presentation. I think there's one negative that I had for everybody, and I just ask you to bring your attention to it in all of your presentations, is when you're making presentations of graphs and diagrams and comparatives and everything else, it's clearly not all original. There's some stuff you draw out of analyst reports and other things, and it's really important that you cite those references. Maybe one or two, but it's really important that that happens. That's what all good academic and analytical people do. So on that front, I'm going to turn it over to Jeremy, I guess, first. Speaker.
Yeah, sorry. Yeah, great job, everyone. And kudos to you and all your efforts. And similar with Peter, I'm a cash flow guy, also balance sheet, but I'm also more open to, I guess, growth. I'm a bit more aggressive that way. But across the board, you guys have made compelling arguments, and you've all cited catalysts. I find that very important. Like, why should I be excited about a stock in addition to its great fundamentals? So yeah, I saw that across the board, and they're just different strengths. So Activision, very clear presentation, very structured, and that's on top of having a conglomerate, a video game conglomerate that sells across different product lines. So good on you for simplifying that to the audience. On Cassie, you made it, offhand. It's a very steady business, but there's something that you pointed out to something very exciting about it, in addition to just a government contractor. So that's good on you on that. McAfee, I'm a special situations guy at heart. Fun fact, thematic used to be special situations back in the day. So I like stocks that have something extra on top of them, and I think McAfee presents that. Netflix, good on you for presenting a category leader or category creator. They literally created a category of streaming. So I think, and you've overall laid out the strengths of the business and why they're able to stave off competition. And PayPal, yeah, great. Again, another category leader, and you were able to talk to field some very difficult questions. And it's a complex business. Like payments is a very technical. It's the plumbing of how we purchase stuff online, and you were able to illustrate how that works in an engaging fashion. So I guess those are just like my high level comments, and I'll pass it on to Steph. Yeah.
Thanks, Jeremy. I think you've made a lot of points already. I would just add to that. It's the presentation you guys did is very, very close to what a professional is going to be doing in their work. So a big shout out to every one of you, the quality of the research and the flows, and everyone just professionally. And this is actual work, and you guys are treating this as something serious. And thanks for contributing back to QUAAF. All these knowledge and research will be carried on for a long time. And the next generation of QUAAF coming in, they'll be able to leverage what you guys have done and learn from you guys. I would say I think Jeremy commented all the pitches, and I think one point that really impressed me is the completeness of the data that you guys presented, not just the company, the industry, but also looking at shareholders, looking at price actions, and what are some of the events that drive up price actions. That is more relevant and more important. It's not academia at all. It's really very close to what a professional will be doing their job. Another point I think would be more make your guys' pitch better is citing other analysts' expectations for the company. For example, the street expectation is this, and our target is in the mid-range. Something like that will give the judges more confidence when we make decisions if we wanted to invest or not. I've not seen one group doing that, so that would be something nice to have. That's my comment. Back to Peter.
Okay, I guess it's almost time for the drum roll. I can tell you that the judges each had a different first choice. But we all had in our top 2 choices the ultimate winner. So it's kind of like a New York mayoralty race. And to that end, we thought that the very best financial presentation and the firm with the strongest balance sheet that compelled us the most was Activision. And on that basis, that's the one we all agreed we would invest in. So congratulations to all of you, and especially to the team at Activision.
Good job, guys.
Excellent. Thank you very much, Peter. Congratulations to Team Activision. Thank you very much to all of the teams who competed and put in a ton of effort into this. We really appreciate it. We hope it was a great learning experience for everyone. And again, a special thank you to the operations team who put this competition together for everyone. I think this is a great way of, QUAAF is already a great way of augmenting the learning at Smith, and these kinds of competitions are a great way of even augmenting what we do within QUAAF. It's a great learning experience for everyone. So thank you everyone for spending the time with us on a Sunday night. And again, thank you to Peter, Stephanie, and Jeremy. All right.
I just want to say that I understand we're getting back together in real classes in September. So I'm looking forward to meeting everybody face to face at long last after 2 years hiatus. Take care of everyone, and thanks so much for all of your hard work on this. It's terrific.
Awesome. Great. Thanks, everyone. Have a good night.